You feel it before you see it. It is not a panic. It is not a crash. It is a quiet, sinking feeling in your stomach. It happens when you look at your 401k balance. It happens when you stand in the checkout line at the grocery store. It is a feeling of dissonance, a feeling that something is wrong with the picture you are being shown. For 40 years, you were told a simple story. Work hard, save money, put that money in the stock market. They promised you that the line would always go up. They promised that if you stayed the course, you would be safe. But today, you look at your insurance premiums, you look at the price of eggs, you look at your retirement account, and you realize the math does not add up anymore. The television tells you the economy is strong. The politicians tell you the S&P 500 is resilient. Your financial advisor smiles and tells you not to worry, but your bank account tells you the truth. You are working harder, but your money is buying less. The gap between what they say and what you live is getting wider. That gap is not an accident. It is a trap. 2 weeks ago, a document slipped out of this building. This is the headquarters of Goldman Sachs. This report was not meant for you. It was not meant for the retail investor or the day trader. It was a private warning shot for the ultra-wealthy. It was a memo for the people who actually run the system, and the message inside was terrifyingly simple. They are not predicting a correction. They are not predicting a recession. Those are temporary. Goldman Sachs is predicting a lost decade. They forecast that for the next 10 years, the S&P 500 will return just 3% per year. 3%. Think about that number. That is not growth. That is barely survival. Let me translate that for you. If inflation is 3% or 4%, and your investments only make 3%, you are making zero money. In fact, you are losing money every single day. Adjust for the cost of living, and that Goldman report is not just a prediction of slow growth. It is a guarantee of bankruptcy for your retirement. It means your nest egg will run out before you do. They are telling you the party is over, but they haven't told you why. They haven't told you that the engine that built your wealth over the last 40 years has been deliberately broken. This isn't a normal market cycle. The rain isn't just falling. Someone turned off the sun. This is a controlled demolition of the middle-class wealth engine. So, you have to ask yourself a question. A very important question. If Goldman Sachs knows the ship is sinking, why are they still selling tickets? Why are your advisors telling you to buy? Why is the media telling you everything is fine? Because they cannot exit their positions if there is no one to buy them. They need you to stay in your seat. They need your liquidity to cash out their own chips. They are selling, and they need you to buy. They are preparing for the lost decade by offloading the risk onto you. The dissonance you feel? That is the sound of the trap snapping shut. I have the answer. I know how to get out. But to understand the escape route, you first have to understand who locked the doors. We have to go back in time. We have to go back to the exact moment the rules were changed against you. It happened exactly 44 years ago, and it started with a single piece of paper. The year was 1982. It was a different world. The blueprint for the modern market was drafted in this year. Before 1982, the stock market was simple. Companies made products. They sold them for a profit. If they made money, they paid you a dividend. That was actual cash in your pocket. They competed with innovation. Then, the rules changed. One specific rule changed the DNA of the entire American economy. It is called SEC Rule 10b-18. It sounds boring. They want you to think it is boring. But this rule was the weapon that killed the old way of investing. Before this rule, if a corporation bought its own stock to artificially inflate the price, it was a crime. It was called market manipulation. CEOs could go to jail for doing it. It was considered fraud against the public. The government protected you from the shell game, but Rule 10b-18 created a safe harbor. Suddenly, the manipulation became legal. The government gave corporations permission to use their profits to buy their own shares. They allowed companies to become the biggest buyers of their own stock. The referee left the field. This was the birth of the stock buyback economy. After 1982, companies stopped worrying about building better factories. They stopped worrying about paying you dividends. They started financial engineering. They used their cash to pump up their own stock price. They convinced you that a rising stock price meant a healthy company. It was a lie. The company wasn't worth more. There were just fewer shares available. It is a magic trick. They inflate the price to trigger their own bonuses, and they leave you holding the empty bag. They built a house of cards. It looks tall. It looks impressive. But it has no foundation. For 40 years, they invited you inside this house. They told you it was safe. They told you it was sturdy. Then they locked the door behind you. This brings us back to the Goldman Sachs leak. Why are they predicting a lost decade now? Because they know the era of easy manipulation is ending. Interest rates are up. The buyback button is broken. Companies can no longer borrow cheap money to pump their stocks. The liquidity is drying up. Without the constant flow of buybacks, the S&P 500 is just a collection of overpriced debt. Goldman sees this. They know the artificial support is gone. That is why they see 3% returns. The machine is out of gas. But the government didn't just change the rules to help corporations. They planted a time bomb in your portfolio, a specific mechanism designed to transfer your wealth to them right when you retire. And based on the Goldman data, the timer hits 0 in 2026. You walk into the market like it is a casino. You think you are betting on the whole American economy. You think you are diversified. You think you are safe because you own the S&P 500. But the casino has changed the game while you were sleeping. You aren't betting on the house anymore. You are betting on a single slot machine. You think you own 500 companies? You don't. You own 7. Apple, Nvidia, Microsoft. The index has become so top-heavy that it is leaning over a cliff. If one of these tech giants sneezes, your entire retirement catches pneumonia. This is not diversification. This is concentration. Goldman Sachs sees this concentration. They do not see it as strength. They see it as a structural fracture. They know that trees do not grow to the sky forever. When the tech bubble bursts, there is no safety net underneath you. But there is a hidden gear in the machine. It is the most dangerous trap for a retiree. It is called sequence of returns risk. If the market goes flat or drops the year you start withdrawing money, say 2026, you enter the death spiral. Imagine your savings are in a bucket. First, there is a hole in the bottom. That is inflation. It leaks 3% or 4% of your value every year, whether you spend money or not. That is bad enough. But now, look at the second bucket. This is the second bucket. This is you paying your bills in retirement. If the market is flat, you're forced to sell shares to generate cash. You're selling your engine to buy gas. You are cannibalizing your own portfolio. The math makes recovery impossible, and watching this happen is your silent partner, the IRS. They are waiting in the bushes. They know about the tax torpedo. They know you are desperate. When you withdraw more money from your 401k to cover the crash and inflation, you trigger higher tax brackets. You trigger IRMAA surcharges on your Medicare. The government gets paid more because you are panicking. They win even when you lose. Let's look at the verdict. Goldman predicts 3% returns. Inflation is running at 3% to 4%. The mechanism ensures you make 0 real progress for a decade. You are running on a treadmill that is moving backwards. Most advisors will tell you to just ride it out, to sit tight. That advice is not just lazy, it is predatory. They are keeping you calm so they can keep collecting their fees. I'm going to show you why the psychological game is rigged to make you the bag holder for the institutions. When Goldman Sachs releases a report saying returns will be low, they aren't guessing. They are preparing to leave. But an institution like that cannot sell billions of dollars in stock overnight. If they sell all at once, the price crashes before they get out. They are like a giant ship. They need time to turn. They need a buyer for every share they sell. They need liquidity. And do you know where that liquidity comes from? It comes from you. It comes from your 401k contributions every 2 weeks. The financial media exists to keep you in your seat, while the smart money heads for the exits. They weaponize your own psychology against you. This is called gaslighting. They tell you that you are wrong for seeing the danger. They call you disciplined for holding a losing hand. They shame you for wanting to protect your capital. They tell you you can't time the market. They make you feel stupid for being scared. But fear is a survival mechanism. They want you to ignore it. They're playing a different game. They know the average investor will eventually panic, but they need you to panic last. They need you to hold the bag until they have safely moved their money into cash or gold. This is the bag holder. In every market crash, someone is left holding the assets that nobody wants. The institutions are currently passing that bag to the retail public. They are offloading the risk of the lost decade onto your retirement accounts. You are not crazy for wanting to leave the casino while you still have chips. You are not emotional for wanting to survive. The behavioral trap is designed to keep you hopeful until the moment the floor drops out. They are banking on your inaction. The trap is set. The date is approaching. The institutions are moving. So, what do? Do you freeze? Do you listen to the TV? Or do you counterattack? There is a way out of the burning theater. But it requires you to violate the most sacred rule of modern investing. It requires you to do the exact opposite of what your advisor is telling you to do. I am going to show you the exit. It is called the barbell strategy. It is how the insiders protect their own money while they sell yours. And we are going to build it right now. We do not play their game anymore. The game is rigged. So we change the board. If the S&P 500 is the trap, we simply step around it. We reduce our exposure to the casino. The solution is something the insiders call the barbell strategy. Most advisors put all your money in the middle, in the stock market. That is where the danger is. We are going to move your money to the edges. We want extreme safety on one side and real value on the other. Step 1 is safety. We move a portion of the portfolio to short-term treasuries. We lock in the 4% or 5% yield while it still exists. In a crash, cash is not trash. Cash is oxygen. It gives you the power to buy when everyone else is selling. Step 2 is asymmetry. We diversify away from the Magnificent 7 tech stocks. We look at what the central banks are buying. They are buying gold. We look at value sectors that have been ignored for a decade. Energy, infrastructure, things that real people need to survive, regardless of a tech crash. Step 3 is tactical. We execute aggressive Roth conversions now. Tax rates are historically low today, but the Tax Cuts and Jobs Act expires in 2026. If you wait, you pay more. We pay the tax on the seed, so we never pay tax on the harvest. You must stop thinking like a saver. A saver is a victim waiting to be sheared. You must start thinking like an allocator. The allocator is a sovereign entity. You decide where capital goes. You decide who gets paid. Goldman Sachs has shown us their hand. They believe the American golden age of stocks is pausing. You can ignore the leak. You can hope they are wrong. Or you can act. You can take your chips off the table before the dealer changes the rules again. The system is rigged, yes, but a rigged system is predictable. And if it is predictable, it is beatable. They are banking on your paralysis. We are banking on your action. I cannot save everyone. I can only save those who are listening. Next week, I will be releasing a breakdown of the specific defensive assets the insiders are moving into. If you want to see the blueprint before the paywall goes up, subscribe. Knowledge is the only weapon you have left. Good luck. Disclaimer. This content is for informational and entertainment purposes only and does not constitute financial, investment, legal, or tax advice. The views expressed are those of the creator and do not reflect the official policy or position of any agency or institution. Past performance is not indicative of future results. All investments involve risk, including the loss of principal. Consult with a qualified financial advisor and tax professional before making any investment decisions. The Goldman Sachs report referenced is a creative interpretation of market data and should not be treated as a guaranteed prediction. You are responsible for your own financial research and decisions.